Right, Bradley Wiggins, the legendary cyclist, has recently been made bankrupt. You know, we're looking at a guy who had a net worth of £13 million reported at one point, and now to being homeless and losing, you know, maybe even losing his Olympic medal. So we're going to look at how it happened and what the lessons are. Now, we're not here to dig out Bradley Wiggins, an absolute national treasure, and we wish him all the best on, you know, putting his life together after this. But when you look at the detail of what's gone on, there are some serious lessons that any director can take from this. So obviously 2012 Olympic gold medalist, Tour de France, you know, winner, first ever British Tour de France winner. Lots of, you know, sponsorship, deals, endorsements, money will have flowed in after that. But in 2020, he had to liquidate two of his companies. One of the companies owed £650,000. The other company owed just under £600,000. Now, what happened is, as the liquidator is looking at how these businesses have become insolvent, he spotted that there is an overdrawn director's loan account, okay, where he'd taken too much money out of the company, and the balance at that point sat at around £760,000. So when you look at something called a statement of affairs on Companies House, on the company we're talking about, you can see in the statement of affairs that there's this overdrawn director's loan account. So what has happened is he's obviously had to take money out of the business to live. You know, as you know, one of the lessons that I think we can all take is, as we start to earn money and our income increases, our lifestyle will need an increase at that rate. Because what happens is income comes in, lifestyle goes up. If income comes down, you've still got to fund that lifestyle. Now, the way that you take money out of a business, and this is really important whether you're turning over 100 grand or 10 million quid, as a director, there's a combination of ways that you can take out your money. I'll tell you how I'm advised by my accountant, is to take a salary of about 12 grand a year through the pay-as-you-earn scheme, and anything on top of that I top up as a dividend, right? But what really happens is I take my salary, and every month I take a bit extra as a drawing on my director's loan account. I go and put the accounts in, and my accountant declares a profit, and he declares a dividend out of the profits that my company has made. What's happened here is he's had to take too much money out of the company for whatever reason, and the company has not had distributable profits to declare a dividend, which has lumped him with this big, nasty, overdrawn director's loan account. Now, lots of directors operate with a director's loan account that's overdrawn. It's very, very common. The problem really comes when you become insolvent and you go through an insolvency process with an insolvency practitioner. Because the insolvency practitioner is duty bound to try and realise assets of the insolvent business to pay some money back for creditors. And in this business, I believe there were some bits and pieces, there was some trademarks that are still trying to be valued and sold right now, and there was this big overdrawn director's loan account. Now, I've never spoke to the insolvency practitioner to dealt with this insolvency, but I'm going to take a guess that there was a conversation between the insolvency practitioner and Bradley Wiggins, and he said, listen, you're going to owe this money out, we're going to have to ask you to pay it back. And what it says in the statement of affairs fee that you can check out on Companies House is expected realisation on the £760,000 director's loan of 600 grand. So that's what they were going to get in. They were going to get in the £600,000, and allegedly it was from a sale of a holiday home in Mallorca. Now, what happened is the insolvency practitioner have started to take action against him, okay? They said that they want the money back. It's not been forthcoming. So they're starting to tighten the screw here. Now, what then happened is Bradley went into something called an IVA, an individual voluntary arrangement. And it's an insolvency process for a person where they are able to put all their debts in one pot and agree to pay it over a longer period of time, generally 5 years. But from what I can understand, the deal on this IVA was, listen, I'm going to go into this IVA to get a bit of protection to stave off bankruptcy from the insolvency practitioner, because that's what will happen. An insolvency practitioner can make somebody bankrupt. And when you've got money, when you've got assets, these things like overdrawn director's loan accounts, they're a lot harder to deal with. They're harder to solve because you've got stuff. So to stave off bankruptcy, it's gone into an IVA. And the deal is, listen, when this property in Mallorca sells, then I'm going to be able to pay you back the money that's owed on this director's loan account. Now, what happened on the 3rd of June is he was declared bankrupt. So that IVA is breached. Basically, the deal's been done, it's not been adhered to, and that insolvency practitioner has actually made him bankrupt now. So trustees have been appointed, and what a trustee in bankruptcy does, it's their job to basically realise the assets to return some money for creditors. And you've seen it in the newspaper that he may have to sell his gold Olympic medals. Now, how has it happened? You know, how can somebody who has done so well and earned so much money end up in this position? Well, I think it's a fact of life that, you know, we're not always trained in financial management, you know, regardless of what we earn. So there was quite a telling conversation with a journalist and a chap called Mr. Sellers, who is Bradley Wiggins' solicitor. And I'm going to read some of it to you. He says, Sir Bradley is the latest in a long line of sporting icons, from boxer Joe Lewis to tennis star Boris Becker, to have fallen on hard times after entrusting their business affairs to people who didn't act in their best interests. You've heard it. I mean, I don't know what the statistics are, but like a large number of Premiership footballers end up going skint because they're earning massive dough, their expenses are really high, they stop playing football, the revenue, their income reduces significantly, but their expenses are still hitting the roof. That's a recipe for disaster. It says, there seems to be this army of so-called advisors who quite frankly rip these people off. Mr. Sellers says, and they are so busy being sportsmen that when it comes to their financial affairs, they just get shafted, and that's what's happened here. He was encouraged to plough millions into various investment schemes which failed. Mr. Sellers claims, but not before these unnamed advisors had taken their cut. He also said that Sir Bradley hopes to recover some of his lost fortune, which amounts to many millions and far exceeds the almost 1 million he owes his creditors. So it's really sad, that, isn't it? You know, and I think it's really important to, you know, to any director out there, if you start to make a bit of money, be careful where you spend it. You know, not everybody who comes to you with a good idea has got your best interests at heart, because it says here that the advisors took their cut. You know, yeah, it is. It's something really, really, really sad. Another big lesson here is be careful how you take your money out of your company, okay? Your accountant will advise you to take a combination of salary and dividends, which is the most tax efficient way to take money out of your company. As long as you're making a profit. As long as you're making enough profits. But if you're watching this channel, chances are business might be a bit slow, bills are creeping up, you're ducking creditors, too much month at the end of the money. It's a sheer sign, it's a clear sign that you're not making certainly the profits that you used to make, or you may be not making a profit at all. Now, if you do that, if your business has stopped making a profit, you can't take dividends. You can't take dividends out of a business that isn't making profit. So what I would suggest is you get monthly or certainly quarterly management information, a profit and loss. Are you making money? If you're making money, are you making enough money to take the drawings that you are taking? Speak to your accountant about this. Because if you're not making enough profit, right? Let's say, for argument's sake, £5,000 a month. You have £1,000 a month salary, £4,000 a month through drawings. And you've done that forever in a day, and your business stops making a profit. But you continue to take that £4,000 a month drawings. If your business cannot afford to pay that £4,000 amount of drawings, at the end of the year when you get your accounts done, that's going to go on an overdrawn director's loan account. You owe that company money. Now, the first problem with that is you're going to get hit with something called S455 tax. Your company is going to be charged an extortionate amount of money. I think it's 33.75%. If I'm wrong, I'm sure someone's going to correct me. That gets lumped on your corporation tax bill. There's also personal tax implications to taking that type of money. But if the shit hits the fan and the business folds and goes into liquidation, you're going to be asked to pay that money back by an insolvency practitioner. Now, if you've got no assets, you live in rented accommodation and you don't have any disposable income, you know what? It'll be written off most of the time. But if you've got an house, you've got a villa in Mallorca, you know, you've got money, you've got you're asset rich and cash poor, it's going to cause you a big problem. And as you've seen here, some people get made bankrupt. And another important point here is, a deal was done here with the liquidator. I believe it was disputed, but according to the liquidator, a deal was done to repay this money. If you're doing a deal with a liquidator, and that could be on an overdrawn loan account, it could be buying some assets of the business, and you renege on that deal, you're leaving that insolvency practitioner no choice but to start legal action against you. That's what they're there for. They're there to represent the interests of the creditors. Okay? They're not there for you. And if you don't stick to the deal that you've agreed to, that's going to benefit the creditors, it's their job to sue you. If you want some impartial, free advice, independent advice, we are here for you, the director. That's why we're called Director First. My name is Chris Word, and I hope you found the video useful. Give us a like, give us a comment, subscribe to the channel. If you've got any questions that you want answering, drop them in the section below. Thank you.